Okay, this is Module 4, Cash Flow Analysis. So at the end of this module, you should be able to understand and discuss the importance of analyzing cash flow of a cooperative, explain the statement of cash flows, identify various sources for cash flows, looking at the direct and indirect method, and identify limitations that you see in current reporting of cash flows. So there's no saying cash is king, and you can't really overemphasize the importance of cash flow analysis in business operations. It's absolutely essential that you know the sources and timing of your cash inflows and your cash outflows. All too often, businesses focus on projected revenues and projected expenses, but forget about when the related cash is actually received. So, for example, you may have an arrangement where you have to pay the suppliers for the goods that you're buying. You may have to pay in 30 days, but on the flip side, when you sell those products to your customers, you may say give them 40 days to pay or 45 days to pay. Obviously, there's a 15-day gap there, and you need to do something to get cash in to bridge that gap. So that could come, in the form of borrowing, that's such a line of credit, etc. But you really have to very carefully consider the timing of the cash inflows and cash outflows. And sometimes when you're looking at as well, like making an investment, and maybe you're looking at establishing a new service or product line, or going into a new region, new area, the profitability may look good, but what you have to do is consider, where on earth are you getting the money up front? Where's the cash coming from to make that investment and to, get through the startup phases of the operation? And that's something that sometimes people overlook, believe it or not. So financial statements are accompanied by a statement of cash flows. So this provides information about cash receipts and cash disbursements, helps predict the amount and the timing of cash flows. It evaluates management decisions by reporting how cash was obtained and used. And it determines the ability to generate the cash necessary to provide patronage dividends, to pay the interest on the debt, and make principal repayments on loans. So it's important to understand the difference between net profit and loss, which is based on an accrual measure of performance, versus the cash flow from operations, which is the amount of cash that's generated from a profit. So as I alluded to earlier, you might have a sale, so you've sold something, but that doesn't mean you get the cash right away. So that's what you're really looking at here, is like you're looking at everything from a cash flow perspective. So when you're planning your cash flow, ideally you'd start off with your strategic plan and identify what specific initiatives you want to accomplish in the year. So then you create your budget. You project your revenues and your expenses. Then you consider when you're going to get the cash from the sales and when you have to pay cash for various expenses. If there's a shortfall or a gap for a period of time, then you're going to need to arrange financing. If you need it, you may not. Then you need to really plan the cash flow, and you have to constantly monitor and adjust. So, if it looks like you're going to be in a cash crunch and it exceeds the amount that you're able to borrow in terms of a line of credit or short-term debt, then you're going to have to do something else. You're going to have to either reduce your expenses, maybe drop some produce or products, or sell assets, or sell some inventories, try to stretch your payment, renegotiate leases, etc. But you're going to have to make changes if you cannot secure financing to cover you during periods of cash shortfall. So there's a couple of short readings here that I think you will find helpful. One is the 4 steps to plan your cash flow, and the other one is taking control of your cash flow. The Living Lab for this module is to analyze a cooperative, can be your cooperative or any other cooperative of your choosing, to analyze their cash flow, to evaluate the current and future health from a risk and opportunity perspective. So basically, you identify the opening cash balance for your cooperative, so cash and cash equivalents. Then you discuss the major sources of cash inflows, whether it be revenues, investments, donations, loans, so where's all the different sources of cash coming in. Then you'd want to identify any potential risk that could have a negative impact on the cash flows that are coming in, that could end up reducing your incoming cash flows, as well as opportunities to increase your future cash inflows. Then you want to discuss the expected major outflows, so payments for goods or services, admin costs, loans, etc. So your discussion should also identify any potential risks for future cash outflows, as well as opportunities to reduce your cash outflows. So what you want to be able to do is provide a conclusion. So is your selected cooperative, is it in a healthy cash flow position for the near future? And if not, explain why or why not. So that concludes the overview of Module 4.